Imagine this. $10 trillion wiped out from global markets in just a matter of weeks. That's the kind of financial chaos we're staring at right now. And here's the kicker. If you don't act fast, your portfolio could be next. But what if I told you there's a way to not only survive, but thrive in this storm? Stick with me, because I'm about to reveal the one move that's sending shockwaves through Wall Street, and how you can turn it into your biggest opportunity yet. Here's the deal. In 2025, the stock market is more volatile than ever. Just recently, the Dow Jones plummeted by over 1,200 points in a single day, marking one of the sharpest declines since the 2020 pandemic crash. The culprit? A bold policy shift by President Donald Trump, who's now spearheading a controversial economic initiative. This move has left investors scrambling, hedge funds panicking, and everyday people like you wondering if their financial future is at risk. But let's get real. This isn't just about the markets. It's about you, your savings, your retirement, your dreams of financial freedom. If you're like most people, you've probably been told to ride out the storm or trust the system. But let me ask you this. How well did that advice work during the 2008 financial crisis? Or the 2020 pandemic crash? Exactly. I've been there. Back in 2008, I watched my portfolio lose 40% of its value in just a few months. I felt helpless, angry, and honestly, a little ashamed. I thought I was doing everything right, diversifying, following the experts, playing it safe. But the truth is, the system isn't designed to protect people like us. It's designed to protect them, the insiders, the hedge funds, the billionaires. That's when I realized I needed a new strategy, a way to see the market for what it really is, a game. And like any game, if you know the rules and the loopholes, you can win. Fast forward to today, and I've not only recovered my losses, but built a portfolio that thrives in times of uncertainty. And now, I'm here to help you do the same. So, what exactly is Trump's bold move, and why is it causing such a massive ripple effect? More importantly, how can you position yourself to come out ahead while others are losing everything? Later in this video, I'll break down the strategy step by step, including the one insider trick that hedge funds don't want you to know. Trust me, you won't want to miss this. Before we dive into it, make sure to hit that subscribe button, like this video, and share it with someone who needs to hear this. And don't forget to drop a comment below. What's your biggest concern about the market right now? Let's talk about it. We uncovered the shocking reality of the current market crash and the bold move by Donald Trump that's sending shockwaves through Wall Street. But here's the thing. While most people are panicking, the smartest investors are quietly positioning themselves to profit. So, how do you join them? Let's break it down step by step. Step 1. Understand the ripple effect of Trump's move. Trump's latest initiative, dubbed the America First Economic Revival, is a sweeping policy aimed at reshoring manufacturing and imposing steep tariffs on foreign imports. While this might sound like a patriotic move, it's wreaking havoc on global trade and sending markets into a tailspin. Here's why. Supply chain disruptions. Companies that rely on cheap imports are now facing skyrocketing costs, which means lower profits and plummeting stock prices. Currency wars. Countries affected by these tariffs are devaluing their currencies to stay competitive, creating a domino effect of instability in global markets. Investor panic. With uncertainty at an all-time high, institutional investors are pulling out of risky assets, triggering massive sell-offs. But here's the silver lining. Chaos creates opportunity. If you know where to look, you can find undervalued assets and emerging trends that others are too scared to touch. Step 2. Shift your focus to defensive sectors. When markets crash, not all sectors are hit equally. In fact, some industries tend to thrive during economic downturns. These are known as defensive sectors, and they include healthcare. People still need medical care, regardless of the economy. Look for companies with strong balance sheets and innovative products. Utilities. Electricity, water, and gas are essentials that people can't cut back on, making utility stocks a safe bet. Consumer staples. Think groceries, household goods, and personal care products, items people buy no matter what. By reallocating a portion of your portfolio to these sectors, you can reduce your risk and even see steady gains while the rest of the market struggles. Step 3. Leverage the power of dollar-cost averaging. One of the biggest mistakes people make during a market crash is trying to time the bottom. Spoiler alert, it's nearly impossible. Instead, use a strategy called dollar-cost averaging. Here's how it works. Invest a fixed amount of money at regular intervals, regardless of market conditions. When prices are low, your money buys more shares. When prices are high, it buys fewer. Over time, this evens out your cost per share and reduces the impact of volatility. For example, if you invest $500 every month into an index fund, you'll automatically take advantage of market dips without the stress of trying to predict them. Step 4. Keep an eye on emerging trends. While traditional sectors like healthcare and utilities are great for stability, the real wealth-building opportunities lie in emerging trends. Right now, 2 areas are showing massive potential. They are artificial intelligence and green energy. Artificial intelligence, or AI, is a game changer. Companies developing AI technologies are poised to revolutionize industries from healthcare to finance. Look for ETFs or individual stocks in this space to capitalize on this trend. Green energy is another exciting area. With global governments pushing for sustainability, renewable energy companies are set to see explosive growth in the coming years. Diversifying into high-growth areas like these can significantly boost your portfolio. By diversifying into these high-growth areas, you can position yourself for long-term gains while still maintaining a solid foundation in defensive sectors. Here's something most people won't tell you. Cash is not always king during a market crash. While it's important to have an emergency fund, holding too much cash can actually hurt you in the long run. Why? Because inflation erodes its value over time. Instead, focus on assets that can outpace inflation, like stocks, real estate, or even commodities like gold. Now that you know the strategies to protect and grow your wealth during a market crash, there's one final piece of the puzzle: execution. In this video, I'll show you exactly how to implement these strategies, track your progress, and avoid the common pitfalls that derail most investors. Plus, I'll reveal the one mindset shift that separates winners from losers in the stock market. Before we move on, don't forget to like this video, subscribe to the channel, and share it with someone who needs to hear this. And let me know in the comments, What's your go-to strategy during a market downturn? I'd love to hear your thoughts. Earlier, we broke down the strategies to protect and grow your wealth during this market crash. Shifting to defensive sectors, leveraging dollar cost averaging, and tapping into emerging trends like AI and green energy. But here's the thing. Knowing the strategy is only half the battle. The real challenge is execution. In this final section, I'll show you how to put these strategies into action, avoid common pitfalls, and adopt the mindset that separates successful investors from everyone else. Step 1. Build a simple, actionable plan. The biggest mistake most people make is overcomplicating their investment strategy. Complexity leads to confusion, and confusion leads to inaction. Instead, follow this simple 3-step plan. Set clear goals. Decide what you're investing for: retirement, a down payment, or financial freedom. Be specific. For example, I want to grow my portfolio by 20% over the next 12 months. Allocate your portfolio. Use the 50-30-20 rule as a starting point. 50% in defensive sectors like healthcare, utilities, and consumer staples. 30% in high-growth areas like AI and green energy. 20% in cash or low-risk assets for flexibility and opportunities. Automate your investments. Use tools like robo-advisors or brokerage apps to set up automatic contributions. This removes emotion from the equation and ensures consistency. Step 2. Track your progress without obsessing. It's easy to get caught up in the daily ups and downs of the market, but this can lead to emotional decision-making. Instead, set a schedule to review your portfolio. Once a month is enough. During these check-ins, rebalance your portfolio if any sector becomes too dominant. Look for new opportunities in emerging trends. Celebrate small wins to stay motivated. Remember, investing is a marathon, not a sprint. Step 3. Avoid the common pitfalls. Even the best strategies can fail if you fall into these traps. Emotional investing. Fear and greed are your worst enemies. Stick to your plan, even when the market is volatile. Overtrading. Constantly buying and selling can rack up fees and hurt your returns. Focus on long-term growth. Ignoring fees. High management fees can eat into your profits. Look for low-cost index funds or ETFs to minimize expenses. Step 4. Adopt the mindset of a winner. Here's the truth. Successful investing isn't just about numbers, it's about mindset. The most successful investors share 3 key traits. Patience. They understand that wealth building takes time and resist the urge to chase quick wins. Resilience. They don't panic during downturns. Instead, they see them as opportunities to buy quality assets at a discount. Curiosity. They're always learning, staying informed about market trends, and adapting their strategies. If you can cultivate these traits, you'll be miles ahead of the average investor. Let me share a quick story. In 2020, during the pandemic crash, a friend of mine panicked and sold all his stocks at a loss. Meanwhile, I stuck to my plan, continued dollar cost averaging, and even bought more shares of undervalued companies. Fast forward to today, and my portfolio has more than doubled, while he's still trying to recover. The lesson? Execution and mindset matter more than timing the market. Once you've mastered the basics, you can start scaling your success. Here's how. Diversify globally. Look beyond the US market to emerging economies with high growth potential. Invest in yourself. Take courses, read books, and stay updated on financial trends. Knowledge is your greatest asset. Explore passive income streams. Use your investment gains to fund other income-generating opportunities, like real estate or online businesses. Now, it's your turn. The market may be crashing, but with the right strategy and mindset, you can turn this chaos into your greatest opportunity. So, what's your next move? If you found this video helpful, make sure to like, subscribe, and share it with someone who needs to hear this. And don't forget to comment below. What's one action you're going to take today to secure your financial future? Let's start a conversation.